Logan has $500 and a question that stops a lot of Canadians cold. Should he buy a stock or buy an ETF? One path is picking a company he believes in and riding it. The other is buying a small piece of hundreds of companies at once. Both are real investing. Both can grow his money. But for a beginner, one is far easier to get right and far harder to blow up. So tonight, we follow Logan's first $500 and find where a Canadian should start. Start with a stock. When Logan buys a stock, he owns a tiny piece of one company, buy a share of a Canadian bank, and he's a part owner of that bank. If it grows and makes more money, his share is worth more. It might pay him a dividend, a small cut of the profits. If the company struggles, his share drops. That's the deal. One company, one bet. When Logan picks a single stock, his money rises and falls with that one business and nothing else. Now, an ETF. It's one fund that holds many companies at once. The common kind is an index ETF. Instead of betting on one business, Logan buys a fund that owns the whole market. One popular Canadian ETF holds every big company on the Toronto Exchange. Another holds the 500 largest American companies. A global one holds thousands, spread across the world. Logan buys a single fund and instantly owns a sliver of all of them. When one company has a bad year, the hundreds of others carry the weight. Here's the difference that matters most. One company can go to zero. A whole index basically can't. Canadians saw this firsthand. Nortel was once the biggest company on the Toronto Exchange, worth more than a third of the whole index. People held it as a sure thing. By 2009, it was bankrupt, and the stock went to zero. Anyone all in lost everything. The index that held Nortel dropped, then kept climbing for years because the other companies were still standing. Spreading the bet is what saves you. So why do people still chase single stocks? Because the winners are loud. Logan hears about someone who bought one tech company early and made a fortune. That story is real, and it's rare. For every stock that takes off, plenty quietly sink, and you don't hear about those. Picking the one big winner before it wins is genuinely hard, even for the pros who do it full time. Logan might get lucky. He might also pour his 500 into the wrong name and watch it fade. Now the quiet thing that decides more than people expect. Fees. Every fund charges a yearly fee called an MER, taken straight out of your returns. A low-cost index ETF in Canada usually charges between about 0.05 and 0.25%. The older mutual funds many Canadians still hold charge around 2% a year. That gap sounds tiny, but 2% is roughly 20 times the cost of a 0.1% ETF, and Logan pays it every year, whether the fund does well or not. Let's make that fee real. Say Logan invests $500 a month for 30 years, and the market returns about 7% a year. With a low-cost ETF that charges almost nothing, he ends up near $600,000. With a 2% mutual fund, same money, same market, he ends closer to $400,000. That fee quietly took almost $200,000 out of his pocket. He never saw a bill. It just came off the top, year after year. There's also the cost that doesn't show up in dollars: time. To pick single stocks well, Logan has to do the homework. Read the company's earnings, understand its debt, its competition, where the industry's going. Then do it again for every stock he owns, 4 times a year, forever. That's real work, and most people won't keep it up. With a broad index ETF, the research is basically done. He owns the whole market, so he doesn't have to guess which company wins. He buys it all and gets on with his life. Then there's a cost that never shows up on a statement: your own nerves. When Logan owns one stock and it drops 20% in a week, it's personal. He checks it at red lights. He thinks about selling at the worst possible moment. One company swings hard, and so do his emotions. A broad index moves more gently because it's hundreds of companies averaged together. The calmer the ride, the more likely Logan stays invested. And staying invested through the scary years is where most of the real money gets made. So what does Logan give up by not picking stocks? Honestly, not much. With a broad ETF, he earns close to whatever the whole market earns. Over long stretches, that's been roughly 7% a year on average. Most professional stock pickers, the ones charging high fees, fail to beat that simple index over time. Logan pays almost nothing and quietly keeps pace with the whole market, while many of the pros pay more and still end up behind. The simple option is also the strong one. None of this means stocks are bad. They have a place. If Logan loves a company and wants to own a piece of it, that's allowed, and it's a great way to learn how markets work. The guardrail most calm investors use is simple. Keep the single stocks small. Put the core of your money, say 90%, into broad, low-cost index ETFs. Let the last 5 or 10% be fun money, the stocks you pick yourself. If they soar, great. If they don't, your future wasn't riding on them. Here's where the Canadian part matters. Where Logan holds the ETF changes how much tax he pays. Inside a TFSA, his investments grow completely tax-free, and he pays nothing when he takes the money out. Inside an RRSP, he gets a tax break now, and the money grows untaxed until retirement. For most Canadians starting out, the move is simple. Buy a broad, low-cost index ETF inside your TFSA first. Same fund, same market, but the government stops taking a cut of the growth. So how does Logan actually do it? Less work than he expects. He opens a TFSA with an online broker, and many Canadian ones now let him buy ETFs with no trading fee. He picks one broad, low-cost index ETF, the kind that holds the whole market in a single fund. He sets up an automatic transfer, say $500 on payday. Then comes the hard part, doing nothing. No checking it daily, no tinkering. He buys every month and lets it compound. This is the boring habit that quietly builds wealth. Logan buys the same ETF every month, no matter what the news says. When the market's up, he buys. When it crashes and everyone's scared, he buys then too, because his shares are on sale. He keeps showing up every month and lets compounding do the work. 30 years of steady buying, with fees near zero, does more for him than any hot stock tip ever could. Slow, dull, and it works. So back to Logan's $500. Where should a Canadian beginner start? For almost everyone, it's the broad index ETF, held inside a TFSA, bought every month. It's cheaper, safer, takes less time, and keeps pace with the whole market. Single stocks can come later, with a small slice of fun money once he knows what he's doing. Start with the ETF as the core. Add a few stocks on the side if you enjoy it. That order keeps Logan safe while he learns. Here's the part to hold on to. You don't need to be brilliant to do well at this. You need low fees, lots of companies, and patience for a long time. A low-cost index ETF gives you all three in one move. Buy it inside your TFSA and RRSP. Add to it every month. Then let it grow for decades while you live your life. Logan started with $500 and a simple plan. That's all it takes to begin. So if you only remember one thing, make it this. For most Canadians, a low-cost index ETF, bought monthly inside a TFSA or RRSP and left alone, beats chasing single stocks. Stocks can be the fun on the side. The ETF is the core that quietly does the work. If following Logan's money helped today, hit subscribe so the next Canadian Money Breakdown finds you. Take care of yourself, take care of your people, and put a little money to work today.